What we're going to talk about here is the recent effort by the Department of Government Efficiency to reduce spending. And what we're going to talk about is, yes, that effort might be well and good, but how did the government begin to spend so much in the first place? And what I'm ultimately going to show you is that, again, it's good to make the government more efficient, but at the end of the day, the excessive spending was a symptom rather than the cause of the problem. So I think if we want to ultimately reduce spending, we're going to have to get at the root cause. So again, starting off, why was the government allowed or what enabled the government to borrow so much? So the idea, just to get a little bit of background, so I have the main story in the middle and then I'm going to kind of work around. But in 2007, our debt to GDP was 60%. And now it's about 120%. So how did the government spend so much? There are natural market mechanisms that should limit government spending. So specifically, you might remember, I discussed this in my institutions course, so you might have learned this in an institutions course, but we have this term called crowding out. So the idea here is, which I have here. So this is kind of the quantity of money supplied and demanded at a given interest rate. So the idea here is if the quantity supplied, the quantity of loanable funds supplied in the economy stays the same, and the government starts borrowing more, that should push up interest rates. Pushing up interest rates, it starts to crowd out businesses, and it makes borrowing more costly for the government. In the textbooks, they'll say, well, the government will pay whatever, but that has a natural limiting mechanism. But as the government drastically increased its borrowing, this didn't drive up interest rates, right? So the story is going to be what the Federal Reserve has been doing with this money supply, right? And then the big story is going to be why it started doing this with money supply. So the Federal Reserve started increasing the money supply, which kept interest rates low for a while until the recent inflation. So so the idea here is that it's not. The government just can't spend however much it wants. When I talk about this is fiscal policy, this is Congress, right? However, what is going to be the root of the problem is that monetary policy makers have enabled the fiscal policy makers to spend. This is going to bring up the idea of Fed independence. But let me start at the beginning here and start going into why the Fed was increasing money supply. So to do this, we have to go back to the 2008 financial crisis. That was a watershed moment in terms of monetary policy. To give you a couple numbers, if we look prior to 2008, the money supply, you can measure this by Fed assets. When the Fed, to create dollars, it buys assets, right? So looking at Fed assets or just looking at the monetary base, prior to 2008, the amount of money, the Fed would increase the amount of money by, on average, 5.9% per year. And if you look, let's say 17 years before, because I'm going to go 2008 to 2025, if you look 17 years before 2008, it increases at 5.9%. If you go 2008 all the way back to like 1960, it's increasing at 5.9%. However, after 2008, right, the Fed started printing money in response to the financial crisis. It's doubled the rate of increase, 12.6% per year, 2008 to 2025. Now, keep in mind, these are compound rates. So this is growing at almost over twice the rate, and this is compounding every year. So this is a massive increase. So the question is, why did this happen, right? So going back to the 2008 crisis, this was a banking crisis. So all of a sudden, the banks, the banks were failing. And the Fed had a short-term bailout. This was was the TARP, right? Was it trouble asset relief? This has been, at least by the media, termed the bailout, right? This was a very small portion of the bailout. So they got some TARP loans and they paid them back, right? And so the media will say, well, the banks paid back the bailout. That was just a stopgap measure. After 2008, the Fed needed to recapitalize these banks. Right? So in other words, TARP just kind of solved a short-term problem. But the longer-term problem was bank capital was wiped out. And regulators view bank capital, right, as a cushion. We've to give you an example, we've gotten rid of the reserve requirement ratio, and now regulators focus on bank capital. So what the Fed wanted to do was increase the amount of bank capital, right? So what the Fed did was the zero interest rate policy. So what the Fed said was, banks, you can borrow from, in the Federal Reserve market, which supported, at 0%, and I'll make sure that you can borrow at 0% for years, right? So this is, you can borrow at 0% now, and I guarantee you'll be able to borrow at 0% for years, right? Now this is not me and you can't borrow, this is banks, members of the Federal Reserve System. So what does that allow these banks to do? Well, they can borrow at 0%, and then they can buy risky assets, right? And the first sort of asset that they bought was Treasury securities. Remember, Treasury securities, 10-year, 30-year, they have interest rate risk. So they are default risk-free, but not interest rate risk-free. So the idea here is, banks were able to borrow at 0%, right, and buy 3 to 4% Treasury securities, no default risk, right? Banks also went in and bought some stocks and so forth, but as just a pure default risk arbitrage, right? The Federal Reserve allowed banks to borrow 0% with the definite purpose of being able to buy treasuries at 3 to 4%. So what this means is banks make 3 to 4% per year, not on their own money, but just, this is an arbitrage. They make 3 to 4% per year out of nothing because they're borrowing at 0% and they're buying at 3 to 4%, right? So this, again, gives banks essentially free money, right? That was the purpose of it, to give banks free money to build up their capital. However, this has, and I wrote here, quote, unintended consequence, is when these banks are buying treasuries, well, that's financing government spending, right? So all of a sudden, the federal government, Congress, gets a bunch of money because of what the Fed is doing here to recapitalize the bank. So all of a sudden, the federal government gets a massive influx of money. You can think of everything that the banks borrowed under zero interest rate. I shouldn't say anything again. Much of it can go into stocks and bonds and so forth. But the idea is a great amount of what the banks borrowed under the zero interest rate policy directly went into government spending, right? So that was the massive sort of boost to government spending. Since then, so I have this kind of here, this arbitrage, right? Borrow 0%, lend to government 4%. Now, keep in mind, you can see the effect of this over time, 2008, 2009, 2010, 2011, this pushed treasuries down to about 1%, right? So the 10-year, 30-year was a little bit above 1%. Even at that, there's still an arbitrage. Borrow at 0%, earn 1%, right? So again, unintended consequence, finances massive government spending. Then, since then, particularly more recently, this is where, this is a very clear consequence of the 2008 crisis. And then the problem is government spending, once it gets started, doesn't stop. So it's very hard to say, okay, now I have a budget of, billions of dollars for X, Y, and Z government agency. And then that's just not taken away. So this was what you could say is the catalyst that started the government spending. And then the various increases in Fed assets and in the money supply that the Fed has done since then in response to COVID has further enabled it, right? So the idea here is ultimately what is causing the massive government spending. This was the catalyst, and then additional Fed printing that since then, asset increases has enabled it to continue. So this brings up the question of Fed independence, right? If you haven't, if you don't have a degree or haven't spent a lot of time thinking about monetary policy, the core of our monetary system relies on Fed independence. And what this means is the Fed is independent from the fiscal policymakers. So you have the fiscal policymakers who are Congress, right, who spend, right, and the Fed is independent of them. So the whole idea of this is, of course, the people, Congress always wants to spend a lot, right? So this system, the Fed independence, is to constrain spending by Congress. But Congress always spends a lot. I'm a congressperson and I want to build help build factories in my districts. I want to essentially buy votes, for lack of a better phrase, right? So the idea of this is, if you merge monetary and fiscal policy, then I, as a congressperson, I can spend on my district, and then I can print money to finance my spending, even if we don't have it, even if I can't borrow it from markets. I don't care about borrowing it from markets, because I'll print it and spend, right? So the whole idea is to separate these two, to say, okay, Congress is going to spend, but the Federal Reserve will not finance their spending. The Federal Reserve's focused on price stability, maximum employment. Again, maybe more focused on price stability, so they don't care what Congress does. If Congress spends a lot, well, you're just going to have to pay a higher interest rate. As the Fed, I'm not going to go in and finance you, right? So that's Fed independence. That makes sense, right? This is looking at thousands of years of monetary failure. Going back to Rome, there was no separation of monetary and fiscal policy. The emperor printed and spent, right? Controlled monetary, controlled fiscal policy, right? So it is absolutely sensible to separate monetary and fiscal policy. What's going on here is it's becoming less and less tenable to say that our Federal Reserve is independent from our fiscal policymakers, from Congress. There has always been, Fed independence has always been somewhat of an ideal, even having going back to Reagan and Volcker, Reagan really trying to pressure Volcker on monetary policy. But since then, we have had what is probably a much more interdependence between or let's just say dependence of fiscal policy on monetary policy. Again, we could say the catalyst was an unintended consequence. We want to bail out the banks, we want to recapitalize them. Unfortunately, that's going to also finance a lot of government spending. But the persistent financing of government spending, particularly under the Biden administration, we had a kind of a Keynesian policy and government spending to prop up the economy, and the Fed, financing of that. So independent of the catalyst, we have had what appears to be Fed financing of government spending. So at the end of the day, to kind of wrap things up, the Department of Government Efficiency, Effectiveness, whatever it is, if you want the government to reduce spending, then yeah, that's a good thing. But ultimately, if you want to reduce spending and keep it low, right, not just kind of find weird things in the government and stop those contracts. If you want to actually, get government spending under control, you're going to have to get to the root cause, which is to make sure that the Fed is independent and the Fed does not finance Congress's spending. Because if the Fed doesn't finance it will stop, right? But if you just stop some of the kind of, let's say, not so bright spending, but you still allow the Fed to finance it, well, you can stop that spending, but tomorrow there's just going to be new stuff. You have to stop the source of the spending. And again, that's the Federal Reserve. Have a great day.